Hello, I'm Phyllis Grimes from the Internal Revenue Service, and welcome to today's webinar titled Payment Alternatives When You Owe the IRS. This webinar is designed for tax professionals, small business owners, and individuals who need information on dealing with an outstanding federal tax debt. We hope you will find our presentation both helpful and informative. Before we begin, we'd like to extend a welcome to any participants from the news media. If you are with the media, please send us an email message at sbse.webinars@irs.gov with your contact information. Our media relations staff can assist in clarifying the discussion or answering any questions you might have following the presentation. Everything we talk about today, from forms, instructions, publications, and web pages, is available on www.irs.gov. For your convenience, we have provided you with a PDF file of this presentation to download, print, and take notes on. It includes a list of the majority of the resources we'll mention today. If you did not notice it previously, you will see a link to download the file on this webinar page. You can ask questions during the webinar by clicking the Ask a Question link under the PowerPoint window and selecting the Submit button. At the end of this presentation, a team of subject matter experts will respond to your questions. We will answer as many questions as time allows and ask that you limit your questions to the topics covered in the webinar today. Please do not ask questions about specific case-related situations. We simply cannot provide guidance for individual situations in this forum. Also, please avoid inappropriately disclosing any sensitive or identifying information about you, your business, your clients, or anyone else when you submit a question. And finally, I would like to remind our audience that the information contained in this presentation is current as of the date we filmed the webinar, and that it should not be considered official guidance. The program will be archived on our website at www.irsvideos.gov for later viewing, in case you want to review what we cover or recommend this program to others. I think that does it for the administrative information. So let's turn to what we will be covering today. We realize that there are many taxpayers struggling to make ends meet. That's why over the last several years, the IRS has announced a series of Fresh Start initiatives. These initiatives are designed to help struggling taxpayers by, for example, expanding access to installment payment plans, raising the bar for when a notice of federal tax lien is generally filed, and allowing more flexibility in our Offer and Compromise program. Payment plans and offers and compromise are two of the most common payment alternatives, so that's what we'll be focusing on today. We hope to make this Payment Alternatives When You Owe the IRS an annual event occurring each fall, and will cover other topics in future years. We welcome your suggestions and recommendations on topics to cover in the future. You can send those to us by email at sbse.webinars@irs.gov. Now, before we begin, it is important to say that any alternative for paying past due taxes, the alternatives we'll discuss today and any other, comes with a prerequisite. Before any alternative will work for you, you must ensure that you are meeting today's federal obligations and will be able to meet all your tax obligations into the foreseeable future. For most individual taxpayers, ensuring current and future compliance with paying your taxes begins with taking a hard look at the amount of federal income tax being withheld from your pay, and, if you are required to make them, the amount of your quarterly estimated tax payments. Are they adequate to cover your current and future tax obligations? If not, you have some adjustments to make. The most common debt we see among business taxpayers is withheld payroll taxes, the federal taxes being taken out of employees' pay. If you are running a business and get behind on those taxes, you'll need to take a hard look at your business income and expenses, including payroll, to see where you can adjust. And the key point here is that you need to be making adjustments to your withholding or business expenses, for example, before you start thinking about the alternatives for paying off any past due taxes. Think of it this way. There is little point in trying to pay yesterday's overdue taxes if you can't pay what you owe today and will owe in the future. If you find yourself in that situation, chances are you're making things worse, not better. So as we go through a couple of the alternatives for paying off overdue taxes today, keep this prerequisite in mind. First, you've got to get your current tax payments straight and ensure you are not going to owe in the future. Help with keeping up with current and future taxes is available from the IRS. Start by visiting our website and searching by relevant keywords like withholding, estimated taxes, small business, and payroll taxes. Your search will result in several IRS web pages, web-based tools, and publications to help you get and stay in compliance. Okay, now assuming current and future tax compliance is covered, let's look at two of your alternatives if you owe the IRS. Again, the alternatives we're covering are Installment Payment Agreements and Offers in Compromise. First, installment agreements. IRS payment plans or installment agreements run the gamut from a 10-day agreement to a monthly payment plan that can last as long as the collection statute is open. The Fresh Start Initiative enhancements to our installment agreement program were covered in last year's Payment Alternatives webinar. You can still view that webinar, by the way. It's on our web portal at irsvideos.gov. But to summarize quickly, under Fresh Start, both individuals and small businesses have greater access to streamlined installment agreements. For example, before Fresh Start, individuals who owed $25,000 or less and could pay in full within 60 months or less qualified for a streamlined installment agreement. With Fresh Start, those criteria were increased so that individuals who owe $50,000 or less and can full pay within 72 months or less qualify. Now, a full discussion of the IRS Installment Agreement Program could last the length of this webinar, if not for an entire day. So today, we will only focus on the most common types of agreements available to the largest number of taxpayers. Before we cover the technical aspects of installment agreements, let me tell you that the IRS has options such as an online application and making payments by direct debit or payroll deduction that make it much easier for taxpayers to set up and maintain their agreements. Setting up installment agreements online and making the payments via direct debit has significant advantages for both taxpayers and the IRS. The benefits for the taxpayer include the whole process is handled online. No direct contact with IRS. No letters back and forth and no calls. Taxpayers can apply soon after they file their return and before they get a bill. In other words, taxpayers can set up a payment plan quickly and start paying down their balance right away to keep penalty and interest charges to a minimum. The application is simple and the prompts are easy to follow. The information required is not extensive and is secured behind the IRS firewall. And the taxpayer gets immediate notification when the application is approved and final. With direct debit agreements, there are no missed payments, no remembering to write and mail a check each month, and a lower setup fee, $52 versus $105 for a regular payment agreement. And the benefits to IRS of online payment agreements and direct debit payments are tremendous. The cost reduction associated with processing paper checks will save American taxpayers millions. Also, direct debit installment agreements are less likely to default because the payments are automatic. Considering all the advantages of taxpayers setting up installment agreements online and making their payments by direct debit, it really is the future. The only question is how soon we'll get there. For the tax practitioners in our audience, if you have a current power of attorney on file, you can also set up a payment plan online on behalf of your clients. If you have any problems using the online tools, the old-fashioned methods are still available. For individual clients, you can submit an application in writing using Form 9465, Installment Agreement Request. Call the IRS toll-free number at 1-800-829-1040, call the Practitioner Priority Service, or PPS line, or call us at the number on your notice or bill. We are working to expand the proactive self-help options for businesses to set up installment agreements. Look for some announcements on this next year. In the meantime, your best options are to call the IRS toll-free line for businesses, 1-800-829-4933, or the number on your billing notice. So who can use our online payment agreement application today? Put simply, any individual taxpayer who qualifies for a streamlined installment agreement can use the online application. Some business taxpayers also qualify for a streamlined agreement, but are currently unable to apply for a payment plan online. So the next question then is, what are the qualifying criteria for a streamlined installment agreement? There are 3 parts to the answer. First, the taxpayer must have filed all required returns, owe $50,000 or less, and be able to pay in full within 72 months or before the collection statute expires, whichever is first. Those basic criteria are broad enough to cover the vast majority of individual taxpayers with an overdue income tax debt. Second, if the balance due is $25,000 or less, then qualifying taxpayers are individuals, out-of-business sole proprietors, and operating businesses owing income tax only, in other words, no payroll tax debt. Third, if the balance due is $25,001 to $50,000, then qualifying taxpayers are individuals or out-of-business sole proprietors. Note that operating businesses are excluded at this level of debt. In addition to the qualifying criteria, we have one other requirement. If the balance due is between $25,000 and $50,000, payments under the streamlined installment agreement must be made by direct debit or payroll deduction. Again, automatic payments reduce the chance of a default. So to summarize quickly, individual taxpayers can set up an IRS payment plan online if they meet the criteria for a streamlined installment agreement. And for individuals, those criteria are: they owe $50,000 or less, can pay in 72 months or less, and if more than $25,000 is owed, payments must be by direct debit or payroll deduction. Now, before we move on, I'd be remiss if I didn't mention several benefits associated with streamlined installment agreements, whether set up online or not. First benefit, no lien is required. It may be filed in some cases, but it is not required. This benefit is a great incentive for taxpayers to quickly and proactively set up a payment plan online before the collection process really starts. For example, you e-file the return, paying as much as you can at the time. When you get the acknowledgement that the return has been successfully received by the IRS, you go online and set up a payment agreement for the balance. To minimize the default risk, use direct debit to make the payments, and then, when the balance is paid, the payments stop, and you're done. Second benefit, no financial information is required for a streamlined installment agreement unless the taxpayer has defaulted on an agreement in the last 12 months. So absent a recent default, you do not need to submit a collection information statement. Third benefit, no managerial approval of a streamlined installment agreement is required. So for the individual taxpayer who meets the streamlined criteria and sets up their payment plan online, this means that the last screen they're going to see will say, "Congratulations, your installment agreement is approved. Thanks, and please print this page for your records." Now let's move on and talk about payment plan options for taxpayers who do not meet the criteria to qualify for a streamlined installment agreement. Let's set the stage. We are talking about individual taxpayers who owe more than $50,000, operating businesses that owe more than $25,000 in income tax, and operating businesses that owe payroll tax. We'll start with individuals who owe more than $50,000. You do have the option to pay down your total tax debt to below $50,000 and then apply for an installment agreement. The streamlined processing criteria would apply, and then you could apply online. For example, a taxpayer with a $60,000 liability on their return could send it in along with a $15,000 payment. Then, when the return is accepted and the payment posts, they can apply for an installment agreement under the streamlined criteria for the $45,000 balance. An operating business with more than $25,000 in income tax owed can do the same. Pay the balance down to less than $25,000 and then apply for an installment agreement. Now, what if the individual or business can't pay down their balance to meet the streamlined criteria? Or what if we're talking about a business that owes payroll taxes? Let's start with the payroll tax scenario because the IRS does have an installment agreement option available. We call it, rather cumbersomely, the In-Business Trust Fund Express Installment Agreement. In business because it applies to operating businesses. Trust fund because it involves withheld payroll taxes. And express because the application process is similar to that of a streamlined agreement. When can a business get one of these in-business trust fund payment plans? First of all, remember the prerequisite I mentioned in the opening. The business must get and stay current with their payroll tax deposits. We monitor all payroll tax installment agreements closely for compliance with current deposit requirements. Assuming the business is and stays current with their deposits, they qualify for an in-business trust fund express payment agreement if they owe $25,000 or less in payroll taxes. If they owe more, they can pay it down and then apply. The balance due must be paid in full within 24 months. In other words, if the business owes the maximum qualifying amount, the required minimum monthly payment is going to be more than $1,000. And if the balance owed is between $10,000 and $25,000, the payments must be made by direct debit. Now, how do you set up an in-business trust fund express payment plan? As of now, you can't do it online, and there is no application form. Your best option is to call our business tax helpline at 1-800-829-4933. And to keep penalty and interest costs to a minimum, you should call right away. Don't wait for a bill. If you do get a bill, call the number on it immediately. You do not want this situation to drag out. Trust me. Finally, let's assume that none of the streamlined or express processes are available. Now what are your options? Can you still get an installment agreement? Yes, but it's going to take a little longer, and we are going to look at your case a little more carefully. To set the stage again, we are talking here about taxpayers who do not meet the criteria for a streamlined installment payment agreement or an in-business trust fund express agreement. Put bluntly and simply, we're talking here about taxpayers that owe a lot. In any such scenario, we are going to require that you provide us with a full financial statement. If the financial statement indicates that a payment plan is the appropriate resolution to your tax debt, that's the way the case will proceed. However, if the financial statement indicates there are ways you can pay down or even pay off your tax debt, we are going to discuss those alternatives with you first. We may even insist on one or more of them, depending on the circumstances. In addition, before we grant an installment agreement, we are going to look carefully at whether filing a notice of federal tax lien is necessary to protect the government's interests in the event of a default, a bankruptcy filing, etc. And any installment agreement under these circumstances does require managerial review and approval. So what kind of financial statement are we going to look at to evaluate a taxpayer's circumstances? Well, there are three types of statements we may ask the taxpayer to submit. Which one depends on the type of taxpayer and how much is owed. The possibilities are Form 433-F, Collection Information Statement, Form 433-A, Collection Information Statement for Wage Earners and Self-Employed Individuals, and or Form 433-B, Collection Information Statement for Businesses. Each form is progressively more comprehensive. For example, the Form 433-F may be used for wage earners and self-employed individuals. It is comparatively short, 2 pages of summary financial information and 2 pages of instructions. You'll be asked to submit this form with any written request for an installment agreement where the balance due exceeds streamlined processing criteria. Our automated collection system staff, the folks who make and receive collection-related calls, may also ask you to submit the Form 433-F when you talk to them about an installment agreement. Field revenue officers may use the simpler Form 433-F in the case of a wage earner or self-employed individual if the taxpayer owes less than $250,000 or less than $100,000 if the debt is a trust fund recovery penalty. Where the balance due exceeds those amounts, and at their discretion, a revenue officer may require the more comprehensive Form 433-A, Collection Information Statement for Wage Earners and Self-Employed Individuals. This statement is more detailed. Wage earners are required to fill out pages 1 through 4, and the self-employed must complete pages 1 through 6. You may be asked to provide verification of items on the Form 433-A. Businesses with an outstanding tax liability will be asked to complete Form 433-B. Like the 433-A, this is a 6-page form, and all sections must be completed as applicable. Continuation sheets are often necessary, and verification of items on the form must be provided. Verification may include, but is not limited to, the taxpayer's balance sheet. However, you may submit the taxpayer's income statement in lieu of completing the income and expense section of Form 433-B. Now, to summarize, if your client doesn't qualify for a streamlined installment agreement, or in the case of payroll taxes, an in-business trust fund express payment agreement, the IRS is going to take a closer look before granting a payment plan, and that closer look begins with a financial statement on one of the forms discussed. So it is to your advantage to be familiar with the financial statement forms and have the right one ready to go in advance. Having the form ready to submit will make your installment agreement requests go much more smoothly. Here are some resources to help you. Internal Revenue Manual Part 5, Chapter 14 covers installment agreements. Internal Revenue Manual Part 5, Chapter 15 covers the preparation and use of our financial statements. IRS Publications 1854, How to Prepare a Collection Information Statement, Form 433-A, and 5059, How to Prepare a Collection Information Statement, Form 433-B, may be found on our website at irs.gov under Forms and Publications. General information on installment agreements and all Forms 433 may also be found on our website. Finally, before we move on to the next topic, I just want to say a few quick words about defaulted installment agreements. Remember from the opening that I said any alternative for paying an overdue tax debt comes with a prerequisite, and that prerequisite is ensuring compliance with all tax responsibilities going forward. One common reason for a defaulted installment agreement is failure to meet that prerequisite by incurring an additional period's tax liability. So taking the steps necessary to ensure future compliance is fundamental. That said, all is not lost if you get an installment agreement default notice from us. The key is to respond to the notice immediately. You generally have 30 days to fix whatever the problem is and request that the installment agreement be reinstated. If the issue is missed installment agreement payments, send them in right away and consider switching the payments to direct debit to avoid that problem. If the taxpayer is having trouble paying the agreed upon monthly amount, contact us to discuss lowering the payment. By the way, did you know you can use our online payment agreement application to switch to direct debit payments or request a different payment amount? You can also change the monthly due date if that'll help. As long as the amended agreement still meets the original criteria for a streamlined installment agreement, it shouldn't be a problem. Now, if the problem is failure to meet the ongoing compliance prerequisite, that's a little more problematic. But again, the installment agreement is not irretrievable. If the issue is that the taxpayer has incurred an additional period's tax liability, contact us. We may, and I stress may, be willing to add the additional period to the existing agreement. Just keep in mind, adding additional periods to an existing installment agreement is not a long-term solution. Somewhere along the line, and the sooner the better for the taxpayer, withholding or estimated tax payments are going to have to be adjusted, or a business is going to have to take a hard look at whether they can stay current with payroll tax deposit obligations. Okay, that's all we have on installment agreements. If you have any questions on what I've just covered or on installment agreements generally, submit them by email. We'll leave as much time as we can for our subject matter experts to address as many of your questions as possible at the end of the webinar. Now, let's move on to our next topic, offers in compromise. Okay, with offers in compromise, the place to start is defining, in general terms, what an offer is. An offer in compromise is an agreement between a taxpayer and the IRS that settles a tax debt for less than the full amount owed. If you've heard ads saying you can settle your tax debt, the IRS offer program is what they're talking about. One word of caution, though, if an ad makes promises that sound too good to be true, they probably are. The offer in compromise alternative is not for everyone, and other payment options should be considered first. Generally, the IRS will not accept an offer if you can pay your tax debt in full in a lump sum, through an installment agreement, or by some other means. Taxpayers should also know that submitting an offer application does not, in any way, ensure that the IRS will accept it. Your application only begins a process of evaluation and verification by the IRS, in which we will look at your financial situation and consider any special circumstances that affect your ability to pay.
Hi, my name is Helen, and I work for the IRS. Abusive tax schemes cause harm to many, including you, the federal government, and even the taxpayers who participate in them. It's important that abusive schemes are stopped as early as possible. The IRS would like your help in identifying promoters of abusive tax schemes and the tax preparers using them to help clients avoid paying the proper taxes. The IRS Lead Development Center's mission is to identify and deter individuals who promote abusive tax schemes and/or prepare abusive returns. The LDC evaluates and develops information from both internal and external sources. Taxpayers should be cautioned not to be taken in by promoters of tax schemes. Remind your clients that if it sounds too good to be true, it probably is. Learn more about the role of the IRS Lead Development Center and how to report suspected abusive tax schemes at www.irs.gov and search using the keyword scams.
As part of our Fresh Start initiatives, the IRS has streamlined the offer process in recent years. The application package is shorter, the payment options are simpler, and in some cases, we are willing to allow additional expenses. Nevertheless, the evaluation process can still take several months to complete. On the other hand, the ultimate goal of our offer program is a compromise that suits the best interests of both the taxpayer and the IRS. If you really can't pay your full tax liability, or if doing so is going to create a significant financial hardship, then an offer in compromise may be a viable option for getting a fresh start. So what constitutes a potentially acceptable offer amount? As simply and basically as possible, it is an amount at least equal to the net realizable equity in the taxpayer's assets, plus their ability to make monthly payments over a period of up to 2 years. Note what I just said about the taxpayer's ability to pay over time. Before Fresh Start, the IRS would look at the taxpayer's ability to pay over a period of up to 5 years. Now we look at only 2. This makes the offer program a more realistic option for more people. All that said, let's look at some of the technical aspects of the offer program. There are 3 bases under which the IRS can accept an offer in compromise. 1, doubt as to collectability. Put simply, the taxpayer will never be able to pay what they owe. 2, doubt as to liability. In other words, there is a legitimate question as to the amount the taxpayer owes. And 3, exceptional circumstances exist that would make it unfair or inequitable to require the taxpayer to pay in full. This is the effective tax administration basis for an offer. A discussion of what constitutes exceptional circumstances could go on for quite a while, so we're not going to cover it here. Nor are we going to cover doubt as to liability. This webinar is being brought to you by IRS Collection, where we focus on the most common basis for an offer, doubt as to collectability. So that's our focus. And our focus leads me directly to a great new online tool we made available last January. It's called the Offer in Compromise PreQualifier tool. Taxpayers and their representatives can use this online tool to evaluate whether they are a good candidate for a doubt as to collectability offer. And importantly, the tool gives the taxpayer an idea of what a reasonably acceptable offer amount might be. The tool is very simple to use, and the prompts walk you through the process. So what I'm going to do today is familiarize you with the tool and use it to make some points about offers along the way. But before I do that, let's cover one point: the fundamental eligibility requirements for an offer in compromise. They are: 1, taxpayer can't be in an open bankruptcy. 2, taxpayer must have filed all required returns. 3, and if applicable, taxpayer must have made all required estimated tax payments and all required tax deposits, including those for payroll taxes. If those basic eligibility requirements are not met, then there's no point in discussing an offer, and the Offer in Compromise PreQualifier tool is not going to let the user past page 1. And speaking of page 1 of the tool, what you're looking at is the top of page 1, the status page. As I hope you can see, the bar across the top shows a 5-step process leading to an offer proposal. If the information entered indicates that the user is eligible and might be a good offer candidate, the result is a proposal including an offer amount and possible payment alternatives. There's some language on page 1 I want to draw to your attention. That language is this: this tool should only be used as a guide. In other words, the final decision on any offer application is based on the taxpayer's written and submitted application. All this tool does is crunch numbers, consider answers to multiple choice questions, and indicate whether, maybe, the user is a good offer candidate. I wanted to draw your attention to that language for this reason. Just because the OIC PreQualifier tool indicates that the taxpayer can pay their tax debt in full, that does not mean they can't prepare and submit an offer. And conversely, just because the OIC PreQualifier tool indicates that the taxpayer is a good offer candidate and provides a proposed offer amount, that does not mean the IRS will accept their offer. And one more thing to keep in mind: if you or your client has some special or unusual circumstances, the tool does not take that into consideration. It makes no judgment calls. It really is only a guide. We look at the Offer in Compromise PreQualifier as a burden reduction tool for taxpayers and their representatives. The IRS has worked hard in recent years to streamline the offer process and make the program available to more taxpayers. And the rate at which we accept offers has gone up recently. Nevertheless, it is still true that many offer applications are not successful. And as anyone who has prepared and submitted an Offer in Compromise application can tell you, the process takes some time and effort. There's a good deal of documentation that has to be compiled, organized, and submitted, and there are several forms to fill out. Then, as I mentioned, assuming the applicant meets the basic eligibility requirements, it can be several months before the IRS will be able to evaluate the application. So our goal in creating the tool is to educate the taxpayer before they begin the process of preparing and submitting an offer. And we hope that taxpayer representatives will use the tool to do the same thing. The idea is to give taxpayers some idea of whether the offer process is worth the effort in their case. And we want those who are a good offer candidate to have a realistic idea of what an acceptable offer amount would be. For example, despite what we think are clear instructions on page 1 of the offer instruction booklet, we still get a significant number of Offer in Compromise applications from taxpayers who do not meet the basic eligibility requirements. Using the tool, a taxpayer who doesn't meet the basic requirements can't move past page 1. So how does page 1 of the tool weed out those who don't meet basic requirements? By asking the 4 simple multiple choice questions I alluded to. 1. Are you in bankruptcy? Yes or no? 2. Have you filed all your returns? Yes or no? 3. Have you made your estimated tax payments? Yes, no, or not applicable? 4. If you have employees, have you made all your payroll tax deposits? Again, yes, no, or not applicable. If a taxpayer gives a wrong answer, answers yes to the bankruptcy question, for example, then after a minute or two of using the tool, they get the message in bold letters, you are not eligible because you're in bankruptcy, and they can't go on to the next step. Another example, we still get lots of offer applications from taxpayers who have unrealistic expectations of the program. I'm sure many of the tax practitioners in our audience see the same thing. Taxpayers who want a settlement when they have the ability to pay in full, or taxpayers who expect to settle for less than they can reasonably afford to pay. By walking them through an abbreviated version of the process using the OIC PreQualifier tool, and by showing them what a reasonably acceptable offer amount might be in their circumstances, we hope that taxpayers' expectations will be more realistic. So let's assume the tool user gives the right answers on the first screen. What do they see next? A screen asking them to provide basic information. And this is a good place to point out that the offer tool user remains anonymous. At no point does the tool require the user to provide their name or social security number. And none of the information the user enters is retained. It's dumped at the end of their session or when they hit the Start Over button. So what basic information do we ask for, and why? Basic information includes the total tax debt in whole dollars and the most recent tax year the user is requesting to compromise. In addition, the tool asks for total number of household members over 65, and the taxpayer's location down to the zip code level. Note that the tool does not ask for a street address or a city. So why does the IRS ask the user to tell us how much they owe? Because in order to get that information ourselves, the tool would have to ask for personally identifying information. The tool doesn't do that. As I said, the user is anonymous. Remember, the tool is a guide. You can plug in any scenario you want and see the results under different circumstances. So why do we ask about household size and general location? Remember that what is being considered in the offer process is the taxpayer's ability to pay. Part of that consideration is the taxpayer's ability to pay over time. In other words, their regular income and expenses. To bring a measure of consistency and fairness to the process of evaluating a taxpayer's ability to pay, the IRS has, for many years now, used standard living expenses as a starting point. Standard living expenses are based on the taxpayer's household size and location down to the zip code level. Using the standard living expenses makes the tool fair, consistent, and simple to use. The standard living expenses can be described as the average costs of a typical household in a given geographic area. Now, we all know that an individual taxpayer's living expenses can differ, sometimes significantly, from what is average or standard for their area. And the IRS does have leeway to consider whether an unusual expense is allowable under a taxpayer's specific circumstances. But whether to allow an unusual expense is a judgment call. And recall that I said the OIC PreQualifier tool doesn't make judgment calls. Humans do that. When a complete written offer application is submitted, the applicant will include all their actual living expenses, and we will compare those expenses with the standard for their household size and location. If the claimed living expenses are relatively close to the standard, great. We can move on in our investigation of the application. But where a claimed living expense exceeds the standard, we have to make a judgment call as to whether the expense can be allowed. The human decision on whether to allow a claimed living expense that differs significantly from the standard allowable can be a sticking point in the offer investigation process. Here's a tip. The key to getting past that point is documentation. So when you are submitting an offer application, always include some evidence that we can consider in determining whether an unusually high claimed expense should be allowed. Now, before we move on, if you are not familiar with the standard living expenses, visit our website, irs.gov, and type Standard Living Expenses or Collection Financial Standards in the search box. Now, let's turn back to the OIC PreQualifier tool. The point of our discussion on standard versus allowable living expenses is this. When using the tool, be aware that if a user's expenses deviate significantly from the standard, you need to take the tool's result with a grain of salt. Remember, it's a guide, and any result beyond page 1 is not a definitive yes or no as to whether an offer in compromise will be accepted. Okay, quick recap. Step 2 of the Offer in Compromise PreQualifier tool is basic information on what the user owes, size of their household, and where they live. Now, let's look at Step 3. In Step 3, the user enters summary information on their assets and asset equity. Like in Step 2, the information is basic and much less detailed than what would be in an actual offer application. It's at this point in the tool, as in the formal offer investigation process, that we begin getting to the questions of whether the taxpayer can pay in full, and if not, what a reasonably acceptable offer amount might be. As I said before, unless there are exceptional circumstances, IRS will not accept any offer if we see evidence that the taxpayer can pay in full through borrowing, monthly payments, liquidating assets, or some other means. Nor will we accept any offer amount that does not reflect what our investigation indicates is the taxpayer's true ability to pay. If any combination of asset equity and ability to pay over time indicates the taxpayer can pay in full, they are not a viable candidate for an offer based on doubt as to collectability. And remember, doubt as to collectability, or I can't pay in full, is the type of offer the tool evaluates. There are 10 entries to make in Step 3 on assets. The entries cover bank balances, home value and balance owed, equity in vehicles and retirement accounts, and equity in any other assets. As I hope you can see on the screen, the tool just asks for the numbers here. For example, it doesn't ask where the user banks, just how much they have in the bank. It does not ask the user what other assets they own, just how much equity they have in those assets. If the total asset equity entered by the user exceeds the amount they indicated they owe, the tool is going to tell them that they don't qualify for an offer. However, the tool also says, if you believe you have exceptional circumstances where paying your taxes in full might impair your ability to provide for yourself and your family, review the Offer in Compromise booklet, complete the required forms, Form 656 and Form 433-A, OIC, and submit your offer. Both the phrases exceptional circumstances and Offer in Compromise contain hyperlinks. These links take the user to the OIC instruction booklet. In the booklet, the taxpayer will learn that one possible reason for filing an offer is, I owe this amount and have sufficient assets to pay the full amount, but due to my exceptional circumstances, requiring full payment would cause an economic hardship, or would be unfair and inequitable. The booklet instructs the taxpayer to submit a written narrative explaining their exceptional circumstances along with their offer application. As I said at the beginning of this section, a discussion of what constitutes exceptional circumstances could go on indefinitely. The point I'm making here is that what the tool is telling the taxpayer here is, you don't qualify based on your financial circumstances, but if some unusual or exceptional circumstances exist, send us your written offer application and a human being at the IRS will look at it. Okay, to quickly summarize step 3 of the tool and move on, the user enters their total asset equity. If, based on asset equity, it looks like the taxpayer can full pay, the tool tells the user they'll have to explore other options or ask IRS to consider some special circumstances. Assuming the user indicates that their equity in assets is below the amount of tax they owe, they'll move to step 4, where they enter monthly income information. Again, the information the tool asks for is very basic. There are 8 categories of possible income sources, and if any are not applicable, they can be skipped or the user can enter 0. The categories are 1. Gross wages. 2. Interest and dividends. 3. Distributions from partnerships, sub-S corps, etc. 4. Net rental income. 5. Net business income. 6. Child support. 7. Alimony. And 8. Additional. Again, there's anonymity. The tool doesn't ask where the user works, just how much they make a month. It doesn't ask where their interest and dividends or business income comes from, just how much they are. Then finally, in step 5, the user enters some basic monthly living expenses. And here again, we get into the question of standard versus actual and allowable expenses. So here again, I need to emphasize the point that the Offer in Compromise PreQualifier is a mechanical tool that's incapable of judgment. It's simply a guide. Assuming the user, the potential offer applicant, meets the basic eligibility requirements, the tool will give them a preliminary indication of whether or not they are a good offer candidate and what, under the circumstances, a reasonable offer amount might be. As part of evaluating a user's ability to pay, the tool considers their monthly expenses in what I've described as a fair and consistent manner. More specifically, the tool allows the maximum allowable standard monthly expense for 1. Food, clothing, and miscellaneous expenses, and 2. Over-the-counter medical supplies. For all other expenses, the tool considers the lesser of 1. The maximum allowable standard monthly expense, or 2. The monthly expense claimed by the taxpayer. In allowing the maximum standard for some categories of expense and the lesser of the maximum allowable standard expense or claimed expense for others, the offer tool is doing exactly what a human offer examiner does as a starting point. This is the perfect place to get into a specific example of what a human examiner can do and a machine can't. Remember my tip from earlier. If an offer applicant has an unusually high expense, they need to include some documentary evidence with their application. Evidence a human can evaluate and a machine can't. Evidence the offer examiner can use to make a reasonable judgment as to whether the expense is appropriate under the taxpayer's unique circumstances. Now, I suspect that at this point some in our audience are quickly typing questions about living expenses and the offer tool for our expert to answer at the end of the broadcast. You will get the chance, I promise. But before you send your questions in, let me cover one more thing that may provide some answers, or at least help you clarify your question. Let's assume that the asset, income, and expense information entered in the offer tool indicates that the user is a good offer candidate. What happens next? I entered a hypothetical scenario into the tool, and this was the result. Again, I hope you can see and read this, but just in case, it shows that the taxpayer owes $20,000 and has available asset equity of $5,000. In addition, it shows that the taxpayer has monthly income of $5,000 and typical monthly expenses of $4,000. So at first blush, it looks like the taxpayer can pay $5,000 now and $1,000 a month. That would pay off what they owe in less than 2 years. So again, at first blush, it appears the user is not a good offer candidate. But lo and behold, under this scenario, the offer tool tells the taxpayer, you may be eligible for an offer in compromise if you submit one of the following offers. First, pay $5,000 within 5 months, or second, pay $5,000 over a 6 to 24-month period. So how do we explain that offer proposal? Look again at the last screenshot. The result indicates that after considering $5,000 in monthly income and $4,000 in monthly expenses, the taxpayer has zero remaining income. In other words, in this scenario, the taxpayer has zero ability to make payments over time. So how is that possible? You see, the offer tool asks the user to provide only some simple, basic monthly expense information for which the tool considers the lesser of the standard or the claimed amount. Then, the tool applies the maximum standard allowable living expenses for the rest. Want the details on what the tool used for monthly expenses? I'm not sure you can see it on the screen, but there's a little down arrow in a red circle on the line Typical Monthly Expenses. Click on that arrow and the tool will show all the expenses used in calculating its offer proposal. Okay, at this point I hope you have a good understanding of how the Offer in Compromise PreQualifier tool works and a better idea of the offer process generally. Taxpayers in the audience, you can use this tool to see if you meet the basic eligibility requirements for an offer in compromise, whether you are a good candidate given your financial circumstances, and what a realistic offer amount might be. Tax professionals in the audience, you can do the same to evaluate your client's potential for an offer. And you can plug sample scenarios into the offer tool, as I did. It took me about 15 minutes, and get a better general idea of when an offer will be accepted. As I said at the top of this segment, our goal in creating this tool is education. We have no interest in receiving fewer offer applications. That means less revenue. Our interest is in getting better offers, offers that have a real chance of success. Put another way, it's not in the best interest of either the taxpayer or the IRS for someone to invest their hope, energy, and time in trying to reach a tax settlement when it's not an option. At the end of the day, we hope to receive more offer applications from qualified applicants. Now, let me briefly summarize what we've covered, tell you how to access the Offer in Compromise PreQualifier tool, and then close with giving you some tips on actually preparing and submitting an offer. Then we'll take your questions. An offer in compromise is an agreement settling a tax debt for less than the full amount owed. While offers are a viable option for some, the process is not a quick and easy one, and many offers are not accepted. There are 3 bases for submitting an offer. The most common is inability to pay. The IRS rejects tens of thousands of offer applications each year because the applicant does not meet basic eligibility requirements or because they have unrealistic expectations about reaching a settlement with the IRS. To help manage taxpayers' expectations and to save many the considerable time and energy that goes into preparing an offer, the IRS has created the online Offer and Compromise PreQualifier tool. The tool helps taxpayers considering an offer based on their inability to pay to determine whether they meet the basic eligibility requirements, are a good offer candidate under their current financial circumstances, and what a reasonably acceptable offer amount might be. The offer tool has its limits, and the results are not perfect. The tool is only a guide, and all final decisions on an offer and compromise will be made based on a taxpayer's written application. And finally, and importantly, a positive result from using the offer tool does not in any way guarantee that an offer will be accepted. Conversely, a negative result from the tool does not mean that an offer will not be reviewed and considered. All right, let's wrap up with some tips to help you prepare and submit an offer and compromise. We'll begin by assuming you've considered other options for paying your taxes in full, and it appears nothing will work. So you visit irs.gov, enter the term offer in the search box, do a little reading on our Offer and Compromise page, and then click the Offer and Compromise PreQualifier link. To find the tool more directly, from the home page, click Tools and scroll down. Enter your information anonymously into the offer tool, and if it indicates that you meet the basic eligibility requirements, suggests you're a good candidate, and has given you an idea of what a reasonable offer amount might be in your case, then you'll find a link to the instruction booklet containing all the forms you'll need. Now, tip 1. Be sure to use the most recent forms and instructions when submitting your offer. On the IRS website, you'll always be directed to the most recent forms and instructions. Tip 2. Review the instructions fully before you start preparing your application and related financial statements. At this point, you may also want to watch our instructional video, Completing Form 656, Offer and Compromise. There's a link to the video on the irs.gov offer page, or go to irsvideos.gov. The video walks you through the application, providing tips along the way. Some of the tips may seem simple, but I encourage you to stick with the video. It's not that long, and keep in mind an offer and compromise is a legal contract. Sometimes missing the simplest thing can delay or derail your application. Tip 3. Submitting an offer is not free unless you fall below certain income guidelines. The guidelines are covered in the offer instruction booklet. Assuming you don't meet the low income criteria, you are required to submit 2 separate payments with your offer. One is the application fee, and the other is a non-refundable initial offer payment. The amount of the initial payment on your offer depends on the option you choose for paying the full amount of your offer. As we saw in my earlier example, there are 2 options, a lump sum or periodic payments over 2 years or less. The lump sum option requires 20% of the total offer amount to be paid with your application. For example, if you were offering $5,000 to be paid within 30 days of acceptance, you would send in 2 checks, one for the application fee and one for $1,000 as the 20% initial payment. If you choose the periodic payment option, your first payment is due with your application, and you have to continue making the monthly payments while we consider your offer. So say you're offering to pay $250 a month over 20 months. You'd send in a check for the application fee, a check for $250 as your initial payment, and you'd continue sending in $250 a month while we consider your offer. And your fourth and final tip. Remember the tip I gave you while discussing living expenses? And apply it liberally. Document, document, document. If you have any special circumstances you want us to consider, we're going to need something we can use to evaluate those circumstances. If there are any unusually high expenses, we're going to need something from you we can look to as a basis for allowing those expenses. As an aid and reminder, we recently revised the financial statements you will be filling out and submitting with your offer. They now include a checklist of items you need to include with your application. Double check that list. Read over your application carefully, and please be sure you've included everything you think we'll need to approve your offer and compromise application. Well, that's all we have for you at this time. More information on everything we've covered today is available on our website at irs.gov, and an archived version of this webinar will be available for viewing in a few weeks on our video portal at irsvideos.gov. Thanks for watching, and now I'll turn it over to our subject matter experts to answer your questions.
Happy holidays, everyone. I'm Jerry Kelly Brenner with the Small Business and Self-Employed Division, and we hope you found today's webinar helpful and informative. We're very fortunate to have two senior analysts joining us today. They're subject matter experts from collection policy. Tom Moore, whose specialty is offers and compromise, and Dave Beach, whose expertise is installment agreements. Welcome to both of you. So let's find out what important questions we've received, and we've received a lot of them, Tom and Dave. Dave, I guess this is a good place to start. How long is the collection statute?
The collection statute is 10 years from the date of assessment, and there are a variety of things that will suspend that 10 years from running. A bankruptcy proceeding, the time an offer and compromise is being investigated, and the time that an installment agreement is pending, that is, it's proposed but not accepted, from the time it's proposed to the time it's accepted, those are all things that can suspend the period, the collection period from running, or kind of adding additional time onto the back end there.
So it sounds like there's the general rule, and then there are the exceptions for what may be happening.
Right.
Yeah. Tom and Dave, this is really probably for both of you. It has to do with fees, and it mentions that apparently this person has heard that the fees are increasing, and they're wondering if that's true, and if so, when that's going to be and how much is that going to be, and also if there's interest on these fees. Tom, you want to start with that?
I will. In January, there's going to be a revised Form 656 published, and in that revision, the application fee will be increased to $186, and that $186 fee will be applicable to offers which are submitted after January 1st on that new form. That is an increase from the previous $150, which is in place at this time. For the installment agreements, Dave, I'll turn it over to you.
All right, and as with offer and compromise, the installment agreement user fees are going up January of 2014. The standard installment agreement will go up to $120, and to get an installment agreement reactivated will be $50. The direct debit installment agreement fee will remain at $52, and the low-income waiver user fee will remain at $43. And it's deducted, essentially it's deducted from the first payment that the taxpayer makes automatically. If the payment amount is less than the user fee, then once they've made enough payments to pay that user fee for an installment agreement, then it gets deducted out.
So, Dave, are you saying should a taxpayer add the additional amount to the first installment, or are you just saying that it will be subtracted, and so therefore the additional amount that's paid won't be as much as the normal payments would be? Does that make sense?
Well, I mean, they can do either. They can, if they're sending it in themselves, not a direct debit installment payment, then if they choose to, they can send in the user fee and the first payment. If they just send in their payment amounts, and with a direct debit installment agreement, the direct debit is going to be the amount of the monthly payment, and then at the point where we've collected enough through payments, then they'll deduct the user fee from those payments. So you can either pay it up front, or it will add a little bit to the back end of your payment agreement because that money's been deducted up front.
So one way or another, the fees will be applied.
Correct.
Okay. And it sounds like then that you're both saying, is it January 1st that this is applicable?
Yes.
Okay.
That is correct, yes.
January 1st. Okay, thanks, Tom. And also then, so for offers in compromise, it's going up to $186, and for the standard installment agreement, up to $120. The reactivity is $50. And what was the $52 and $43 applicable to, Dave?
That's for a direct debit, and 52 is for a direct debit installment agreement, and 43 is if the taxpayer's income is below a certain level, and the IRS calculates that based on the last return, the last year's tax return, so the taxpayer doesn't have to request a low-income waiver. It'll be determined when the IA is processed, and that's $43, and those aren't changing.
Okay, thanks for that clarification. The other part of that question was, is there interest on these fees?
Well, in so much as that, that payment has been deducted at the front end, so that's, the tax that would have been paid is still there, accruing penalty and interest. So there isn't penalty and interest on the user fee per se because it's deducted up front, but I guess you could say it has an effect on the overall interest paid because that user fee didn't pay down tax at the beginning. Does that make sense?
Yeah, it does. Tom, how many offers does the IRS process, and what percentage are accepted? And then additionally, what reasons would cause an offer not to be to be returned? What would cause an offer to be returned?
Well, similar to recent years, fiscal year 2013 showed a substantial increase in offers again, so that over 74,000 were received by the IRS. That was an increase from fiscal year 2012 of 16%. In addition to that increase that we had in receipts, there was also an increase in the number of offers that we accepted. And the rate of acceptance for offers in fiscal year 2013 increased to 45% of the processable offers. That was 6% greater than the 39% in fiscal year 2012. And we feel that part of the increase is assistance from the practitioner community in submitting better offers. I mean, that's our key, and it was mentioned in the presentation that the Internal Revenue Service is looking to receive what are known as, what are good offers, what are offers that we can investigate appropriately and make a determination on their acceptability. So we encourage individuals to accept offers that meet the criteria to be accepted, because that is in the interest of both the taxpayer and the government. Now, offers that are not deemed to be reasonable offers just tie up the system, and we don't wish to see those. And although it wasn't mentioned in the question, there is some time frames that we're looking at for the offer investigation, and during fiscal year 2013, the Internal Revenue Service processed 88% of the offers within 9 months. So that can give you, as a practitioner, an idea of the number of the time frame that it's going to take for that offer once it's submitted. Now, complexity of the offer enters into it. If it's a circumstance where the offer is more complex and it needs to go to a field offer specialist, then those can take more time. But as I mentioned, the 88% is the time frame that we're looking at for the offers that are received, and then the time frame that they're processed. I know that returns were discussed during the presentation. And one of the things that we continually look at is that the percentage of returns has not really changed much over the years. So I'd like to just mention some specific issues, reinforce some issues that were discussed that cause taxpayers' offers to be returned. You know, the most important aspect of this is compliance. You know, the taxpayer needs to be in compliance. If the offer is submitted and the taxpayer is not in compliance, then that would cause that offer to be returned. If the taxpayer falls out of compliance during the offer investigation by missing estimated tax payments or federal tax deposits, or by not filing a required return, then that offer is returned. And then all that information that was submitted and the time that's taken place, the investigation that's taken place, you know, that is lost because the offer specialist or offer investigator is not able to complete their determination on the acceptability of that offer. You know, we're also looking at returns for circumstances where the taxpayer, in certain offers, a periodic payment is required during the pendency of the offer. So that periodic payment needs to continue. That needs to be submitted. And if it's not, then that offer will be sent back. And one other thing I would like to touch on is the response to requests for information. It is best if all documentation is submitted with the offer, and we've seen an increase in the documentation being included in the offer package, which helps accelerate the offer investigation. But it's imperative that if the offer investigator is requesting some documentation or some information from you as a practitioner, that information is provided by the date that's specified, or contact is made to explain why that information is not being submitted timely, or what other documents can maybe be provided in lieu of that information. So it's very critical that contact be maintained with the offer investigator during the offer investigation. So those are the main issues involved, and I could speak longer on it, Jared, but I think what I'll do is I'll turn it back over because those are the main ones that we're concerned with. Thank you.
So it sounds like, Tom, that it's important for them to be in compliance both before they are actually applying for the offer, as well as, of course, continuing to be in compliance afterwards. Also, to respond timely and to make sure that when they do submit for their offer, that it's a good one, that it's complete, that they have everything included in order for it to be processed timely. Am I hearing you correctly?
That is it exactly. Thank you.
Okay, absolutely. The next one actually is for both of you. It has to do with refunds. Looks like many are looking forward to the filing season and hopefully getting refunds, but of course it would possibly apply to installment agreements and offers in compromise. So Dave, the first part of it is if an installment is approved and the taxpayer is getting a refund in the current year, will the IRS offset the refund and apply it to the balance due?
Yeah, the short answer to that is yes, we will.
Okay, is there a longer answer to that?
No, that's a short, sweet one.
Okay.
We're always going to, in the case of an installment agreement, we're always going to offset that refund to the balance due.
Okay, so I was just wondering because of for short and long answers, as far as there's a general response, and then sometimes there are exceptions to the rule. But yes, if there is a refund, it will be applied. Then for you, Tom, if you get accepted for an offer in compromise, does it affect following years of refunds if they, of course, would get a refund?
In the offer in compromise realm, the IRS is going to keep any refunds that are due for tax periods extending through the calendar year in which the IRS accepts the offer. So to use an example, if an offer is accepted in calendar year 2013, when the 2013 tax year is filed, or any prior years, if there's still some that are outstanding, and there are refunds due, then the IRS is going to keep those refunds and apply it to the outstanding liability. For 2014 and subsequent, those refunds would go to the taxpayer.
Okay, thanks. Tom, here's another one for you about eligibility requirements for offers in compromise. Will a taxpayer that has multiple years of tax debt qualify even if all years' tax returns are completed? What does it mean And then what does it mean for all required federal tax returns, and how many years do you look back?
The Internal Revenue Manual provides that under normal circumstances, we're going to be looking back 6 years for returns to be filed. Now, as mentioned, there's always exceptions to rules, but that is the normal time frame that the offer investigator is going to review the account prior to completing the offer investigation. The number of tax years involved, if all returns are filed, whether it is 2 years, 3 years, 5 years, does not affect whether or not that offer can be submitted and whether it would be investigated or not. So the answer to the question would be, make certain all returns are filed at least through the 6 years. The offer investigator can make a determination and would let you know if other returns would be required, but at least complete those returns and file those before the offer submission, because definitely if it is sooner than the 6 years, the offer will be returned.
When we're talking about all federal returns, if it was for a business, would that be both the business returns as well as the payroll returns that are associated with that business?
If it's an individual who is submitting the offer, then correct. We would be looking at any taxes that would be any tax returns required of that individual's business, and then also their 1040 returns. So it could be the individual's business and their personal income taxes that would be required to be at least filed.
So we're really looking at compliance across the board that's related to that taxpayer.
That is correct, yes.
Okay, thank you. Dave, this one says, I currently have a client who's on an installment agreement that is auto-debited from their bank account. How can we change that to a payroll deduction from his paycheck?
Yeah, I think if the client, if you get a hold of a Form 2159, the payroll deduction form from the IRS.gov, and complete it, have the taxpayer and their taxpayer sign it and their employer agree to make the payments, then you can just send that in with a request to have the direct debit installment agreement discontinued and the payroll deduction, and switch to a payroll deduction. Or you can, I believe you could do that on the online payment agreement application. It would probably be smoother to download the form and have the employer agree to withhold and forward the payments, though there wouldn't be any delays, and the individual who inputs it would stop the direct debit installment agreement and start the payroll deduction at the same time.
And Dave, again, what form number did you say that was?
It's a 2159.
I'm sorry, I didn't understand that. Say it again.
2159.
2159. Okay, perfect. I appreciate that. Thank you. Tom, here's a really interesting one about really forgiveness of debt. If a compromise is accepted, will the taxpayer receive a 1099-C for the amount forgiven?
They will not. The amount that is forgiven, the tax amount that is forgiven, would not be included on a 1099-C, and it would not be issued to the taxpayer.
Oh, great clarification. Thank you. Here are two of them, one for each of you, really having to do with life, or in your case, for your question, Dave, a death experience. For Dave, it says, what happens to an installment agreement when the taxpayer becomes terminally ill? Does the installment agreement carry on to the taxpayer's estate?
Well, upon death, the installment agreement is a contract between the taxpayer and the IRS. So upon their death, that contract would certainly, if not void, would be voidable. As a practical matter, if the executor or administrator of the taxpayer's estate would be required to resolve all of their debts, or to the extent that the estate is able to. So I think if the executor or administrator continue to make the installment agreements, we would probably keep the installment agreement in force. But if the administrator or executor distributed money and that liability wasn't subsequently paid, then they would be responsible individually for that debt. So it gets a little, there's a little bit of installment agreement, a little bit of contract law, and a little bit of estate tax law in that question.
I understand. Tom, having to do with a divorced couple, if a divorced couple has outstanding balances pre the divorce, can each file an offer in compromise for the full amount due?
In that instance, either taxpayer would be able to file a compromise that could compromise their responsibility for the joint tax debt. So what would happen is the individual would file the Form 656 and their related financial information to the Internal Revenue Service. If a determination is made that an offer in compromise from them is acceptable, then once that amount, the terms of that offer are met, then the individual would be relieved of any remaining liability. Now, for one party to have an accepted offer, that's not going to relieve the other party. The other party would still have their responsibility for payment of the joint tax liability, but one person may submit an offer, and as the question states, both taxpayers may submit offers if they wish.
So both may submit, neither of them is off the hook, is what I'm hearing you say.
Right. If one's accepted and the other is not, then the one who's not accepted would not be off the hook. Or if the other did not submit an offer, then they would not be off the hook because we accepted the other party's offer.
They're both jointly and severally responsible, then? Is that what I'm hearing you say?
That is correct. That is correct.
Okay. Tom and Dave, before we close the Q&A session, what are the most important points you want the attendees to remember from today's webinar? Tom, why don't we start with you?
Thank you. The major aspects, and I've touched on this, and it was touched on in the presentation, but I just want to reiterate the compliance aspect of it. The taxpayer's compliance with their estimated tax payments, with their filing, that is one of the major issues that we have in returning offers before we can even begin the offer process. The other is, for the offer process, the taxpayer should be looking at other alternatives first. The offer in compromise program is for taxpayers who are not eligible for an installment agreement or for some other method of resolving their liabilities. So what we would have you do is to determine if the taxpayer qualifies for an installment agreement and proceed in that manner if that's the appropriate method for resolution. And reminding individuals that the PreQualifier is out there now. While it is not a method to determine whether an offer is going to be accepted, it is a good method to plug in the numbers for your client, determine whether or not an offer might be a feasible resolution, and provide you a ballpark in regards to what reasonable collection might be. So those are the major points that I wish to leave you with today. Thank you.
So be compliant, look for other alternatives first, and use the PreQualifier tool.
That is correct, yes.
Great. Dave, what about you? What do you want them to remember?
A couple things. One would be to be proactive and come to the IRS before we come to you as far as trying to set up an installment agreement. Don't wait for your client or you to get that final demand notice of intent to levy before you make arrangements to get an installment agreement put into place. Our online payment agreement application is a great avenue if you meet the streamline criteria. So if you or your client is an individual and they owe $50,000 or less and can make that minimum payment of 1/72 of the unpaid balance of assessment, that you don't have to wait on the phone. And additionally, I think most of the electronic tax software includes the Form 9465, which can be used to request an installment agreement. So if you know that the balance is going to be less than $50,000, that's a great avenue to get an installment agreement put in place with very little activity on the part of the practitioner or the taxpayer. And just to let everybody know, we are working on an application for business taxes. So that we're hoping to roll something out in the next year or so that would allow businesses to also use an online application if they meet the streamlined or the in-business trust fund express criteria.
So be proactive, use the online payment agreement if they qualify, and electronic software includes a way to be able to apply for an installment agreement, and be on the lookout for one that applies to businesses.
That's it.
Great. Well, thanks, Tom and Dave. That's all the time we have for questions today. Thanks so much for watching our webinar. We hope you learned a few things about what payment options and alternatives are available to you when you owe the IRS. If you have any questions that were not answered today, please visit the IRS website at www.irs.gov using keywords payment alternatives, or simply click the Pay Your Tax Bill icon on the irs.gov homepage to find a lot more information. Certificates of completion will be issued in approximately 3 weeks to those who qualify, and in case you'd like to review this information again or refer it to someone who is not available to view the webinar today, it will be posted in approximately 3 weeks in the IRS video portal at www.irsvideos.gov. Thanks again for your time and attendance, and we hope you have a great day.